Hello and welcome to this edition of Mic'd Up. I'm Pete Seyler, a member of the business development team here at iCM, and I'm joined by Ryan Lehman, iCM's Director of Investments. Ryan, thanks for being here.
Happy to be here, Pete.
Great. So, listen, we've received a lot of questions that are really timely and relevant from viewers of previous Mic'd Up episodes. So, rather than form one topic and take our time today with that, I'd like to split into three distinct questions that we've received from advisors. And so, let's jump in with number one, Ryan. There has been a lot of talk about issues in the commercial real estate market. What risk does this pose to the broader market in general? And what asset classes do you think could be most impacted?
Yeah, really good question there. Definitely relevant to what's going on in the market today. And I would say clearly some headwinds here, especially when we look at this continued work from home trend, which going away a little bit, but clearly still here to stay for the most part. And we've got this significant rise in interest rates over the last 14 months or so. That said, the whole commercial real estate issue is probably not systemic like the housing bubble, the residential housing bubble that happened in that 2007, 2008 timeframe. But we could see a pretty big wave of write-downs and potentially defaults as a good portion of the market is actually going to be forced to refinance their debt in the coming year or two. In fact, if you look at current estimates, there's just about $1.5 trillion of commercial real estate debt that's going to be need to be refinanced or retired by the end of 2025. So a good chunk of the market there. And it's a little bit hard to put an exact figure on what this could mean for the economy, but commercial real estate last year was responsible for about 15 million or so jobs and about $2 trillion worth of GDP. So it could definitely impact overall economic growth if we do get ourselves into trouble. Taking that second part of the question, though, thinking about what investments could potentially be impacted the most. On the fixed income side, the most direct is going to be commercial mortgage-backed securities. Good news here is they tend to be lightly owned by the average investor because they aren't really a part of the major Bloomberg aggregate bond index. So not a huge concern there, relatively small part of the overall fixed income market. And then on the equity side, here REITs are going to be directly impacted. Good news here, though, they're going to largely fall within those small mid-cap value stock indexes unless you directly own a REIT, ETF, or mutual fund. So again, probably an area of the market that's lightly owned by your average retail investor. One positive, though, I would say that investors can kind of rest easy when they think about their agency mortgage-backed security holdings. So these are pools of mortgages. They account for about 30% of the Bloomberg aggregate bond index, but they're going to be purely residential. They're going to be sponsored by your GSEs, so your Fannie, your Freddie, your Ginnie Maes, and all those are going to have generally limited risk because they're actually backed by the full faith and credit of the government.
Great information. Now, as part of your earlier answer, you did mention something about refinancing, and obviously that relates directly to interest rates. And our second question from a viewer is, if the Fed is indeed done with rate hikes and moves towards cuts by the end of the year, will this help solve the issues that we've seen with the regional banks?
Yeah, in theory, it should definitely help. So higher rates, they aren't the only cause of these recent regional bank failures, but they are definitely contributing to the lack of confidence in those banks. And they're also making their deposit rates less competitive with products like money markets and CDs. So if we were to see rates come down, it should help on a couple fronts. So first, it would likely stem the flow of assets out to lower yielding of their lower yielding checking and savings accounts, because those rates on money markets, rates on CDs, they tend to have a higher beta or be more highly correlated with Fed funds and short-term treasury rates. So that should definitely help. And then second, it should also alleviate some of those concerns around losses on their actual balance sheets. So right now, a lot of these banks, they've had to mark down their treasury securities, which are one of their primary holdings. If you see rates come down, it's actually going to cause their treasury holdings to appreciate value. So again, just kind of helping with that confidence in the regional banking system and their balance sheets.
Great. So let's tie it all together. And what do you guys, the investment team, see as the outlook for the broad economy and equity markets for the rest of the year? Do you expect to see a possible recession? And if you do, when do you think that materializes?
Yeah, so thinking about recession, we're likely expecting one later this year, probably in the late Q2 to Q3 type time frame. Number of reasons for that is one, we still haven't really seen the full impact of inflation on profit margins. This is something we've been talking about for a while, but it's also something that tends to have a lag, and it's probably going to start weighing on companies' earnings later this year. Second, they've done a lot to put pressure on the demand side of the inflation equation. They've raised interest rates by 500 basis points in just the last 14 months. This is also something that's going to have lagged effects, so I don't think that's fully baked into the economy as of yet. And then lastly, we have these concerns in the banking sector, and this is more related to the industry as a whole, not just the regional banks. But what this has done is it's kind of created a lack of confidence in the banks themselves in terms of lending. So they've been pulling back a lot of lending, which could accelerate if we do get into some type of recessionary period and put further pressure on the economy. So these are really just a lot of headwinds to work through, and it just doesn't seem like markets have really priced a lot of this in yet. If you look at earnings estimates, at least to us, they look a little bit too optimistic at this point, meaning that there could be some volatility in store for stocks, at least until markets sort some of this out.
Ryan, as always, it's great having you here with us. Really appreciate the insight and the information that you were able to share today. As always, we encourage our viewers to submit questions or connect with us on the business development team for more information. We can be reached at 888-426-4689 or via email at info@icm-invest.com. As always, thank you for watching, and we'll see you next time.